introduction to supply and demand to gain a fundamental understanding of what it actually is. So what is supply and demand? Well, pretty much supply and demand is what drives all markets. Not only the Forex market, not only the stock market, every market, like eggs, bread, oil, whatever. When demand is greater than supply, which means that people buy that stuff, people want that stuff, prices are automatically gonna rise. And when supply is greater than demand, which means that people are either selling or they refrain from buying because price is too expensive, then price will automatically fall, right? And this happens in every market. Take, for example, an ice cream of Ben & Jerry's. Here it usually costs like 6 euros. Nobody buys this on 6 euros. So what usually the supermarket does is they run sales, right? Because they have a lot of supply of Ben & Jerry's, but there is no demand at this price. So what they do is they decrease the price in order to increase demand. So then people go in, a lot of demand, they buy all the ice cream, but then they don't just want to keep throwing away that ice cream at this high demand. So again, prices rise. And then this cycle keeps repeating, right? That was a little bit of a funny example, but hopefully you get the point. On a price chart, supply and demand is usually interpreted as oversold. So you either have supply running out and demand coming in, or overbought, demand running out and supply coming in. And our task as traders is to identify at what zones price will be oversold so we can buy it, or overbought in order to sell it. Again, going back to the previous lesson, this is simply buying low and selling high. And how we do this? Well, we utilize supply and demand zones, once again combined with market structure. And there are a lot of theories. So we have the Wyckoff price cycle, right? The market accumulating while it's being oversold. So right now demand is starting to get in. It pushes up. Then we have distribution. The market is overbought, and then supply is greater than demand. So the market starts going down. And what you're usually going to see is, as I told you, the market moves in cycles. You're going to have up, you're going to have down, you're going to have up, you're going to have down, right? And this is again, market structure, but also within the foundation of market structure, supply and demand is also right there. Right? And then of course you have this here. This is more like, again, I think it's also a Wyckoff schematic. This more takes into account also market structure. So what we have right here is, again, the market accumulating. It's starting pushing up, pushing up, pushing up, getting into that overbought state. It starts to distribute, then it starts pushing down, pushing down, pushing down. And pretty much this is market structure. So there are numerous ways to study supply and demand, but I really want you to understand like really the foundation of it. So how and why do supply and demand zones form? So we're going to get a little bit more technical right there. And I want to always walk you through the psychology behind. Because if you don't ask the very important question, why do supply and demand zones form? And how do they actually form? Then you're missing out. So what is the psychology behind? I call those guys the BFIs. Those are big financial institutions, banks, hedge funds, pension funds. Those are the guys with the money. And they do not trade with one lot like us, even 100 lots, right? Because this is all retail. They trade in thousands of millions of lots, and they probably don't even utilize lot sizes, right? They're probably trading just cash. I don't know. Nobody knows. So whoever pretends to know how the BFIs or how the institutions are trading, you probably don't, right? Very important to understand also is that trading is a zero-sum game. So you have a positive sum game and you have a zero-sum game. A zero-sum game is that when somebody wins, someone else has to lose. In order for someone then to sell one lot of your USD, someone else has to buy one lot of your USD. And some of those people, right, one of those people is gonna lose. Well, a positive sum game is, for example, a service. So if I give you my mentorship, you pay me money, which is my reward, and then I give you the mentorship, which is your reward. So it's a win-win situation, right? There is growth. It's a positive sum game. But a zero-sum game, one person is gonna win, the other person is gonna lose. So in order for someone to sell one lot, someone else has to buy one lot in order to meet the other side. And usually we do not need to worry about the execution of our trades and about liquidity because, yeah, we can always go to our broker and put as many lots as we want, but those BFIs, they do worry about it. So let me give you an example. Imagine that bank X, I don't know, Barclays, JP Morgan, they want to place 1 million lot long on Euro USD. Respectively, what are they going to need is 1 million lots shorts at the same time so their order can get executed. Because if they want to buy one lot, they need to buy it from somebody, right? So if they want to buy 1 million lots, somebody else has to sell them 1 million lots. And usually that seller of 1 million lots, it's not just going to be one person. It is us, it is the whole market. So they need to actually find and generate those 1 million lots of shorts. How do they do this? Well, they trick traders into selling and buying the market, and they generate the patterns we all know. Double tops, triple tops, flags, trend lines, head and shoulders, triangles, pennants, all of this stuff. And they make it look really good so that a lot of people start buying and selling, and they build liquidity in the market. However, what's the bad thing is that after those formations are ready and people are in, then banks will usually launch a big fake position. And what this fake position does, it stops out all the traders. It is very important to understand that when you get a stop loss, your order automatically turns into the opposite order. So a stop loss on a buy position, so if you take a long trade right now and you get a stop loss, then immediately after hitting stop loss, you turn into a sell. You pretty much sold what you bought, right? So if enough people are long, for example, and all of those people are stopped out, they pretty much offer those sells to the bank who wants to buy, right? And this is how banks get their liquidity. However, what is also important to note is that when they launch this fake move to stop out the traders, they also run into some drawdown, because in order for them to launch this fake move, they still have to enter the market. And this is usually why they will come back to that same place they launched their fake orders, mitigate those losses at break even, and then launch again with their own liquidity. So this is really theoretical. I want to jump into an example right now and actually walk you through how that happens. But hopefully so far you're getting the point. Say at this precise moment, a bank wants to buy 1 million lots, exactly what we said before. What do they need in order to buy those 1 million lots? They need 1 million sells, right? And they need 1 million lots to be on the sell side in order for them to put their 1 million lots on the buy side. So what they start doing is they start generating the patterns, right? They make a double top. What is right there? A lot of sellers are entering, right? So what do they need? They need sellers. Here we have a double bottom. What does this make traders do? It makes them go long, right? So very good. They go long right now. What is below the double bottom is their stop losses. And if a buy gets a stop loss, what does it turn into? A sell order. So what they're going to be doing is they're going to be accumulating price, doing some math stuff. And then all of a sudden you get this very huge momentous move below or above, respectively, in an opposite example, that pattern, right? And this is what I call the fake move. And in this lesson, we're going to be seeing the fake move drawn with this red kind of rectangle, right? And if all the stop losses right now of the buyers are taking in, they turn into sell orders. And also what happens is that there are people that are looking to take the breakout. So for a lot of people, this is a structure break. They have their sell stop below, right? So people are entering shorts as the market breaks. What do the bank need? They need shorts, right? Then the market gives you a little bit of a pullback. A lot of people start entering short from here. Why? Because it's a lower high. What do the banks need? They still need shorts. They're still putting in their 1 minute lots, right? And then what suddenly happens is the market expands massively. So after the bank actually got their 1 million sales, they launch their buys. And they might not launch all of the buys at the same time. So maybe they just launch like 500K lots right there. Right? But what I want you to pay attention to right now is what I told you about this, if I just delete all of this fake position right here. So in order for them to make this fake position, they need to sell, right? So when they sold right there and then when they bought right here, they're running into drawdown because they're running in sells right there. So what happens right now is price reaches to a satisfactory level, right? And then they take profits, they take some partials, and then they start the process again. Right? They start generating the patterns. Double top right there. All right, the market starts pulling back. What do we have right there? Double top. Who do we have right there? Sellers. Ooh, double bottom. The market is making a higher low. Who do we have right there? Buyers. Right? The market comes in. Stop loss of the sellers takes in new buyers. The market goes down. Stop loss of the buyers takes in new sellers and stops out everybody. Right? Then the market comes in just before this move, which is usually going to be called an order block or supply and demand zone, which we're going to be covering a little bit later. And then they start accumulating again. Boom, 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 boom. And then again, they launch a new fake move into the previous fake move. But with the new fake move, they're going to close the previous one at break even. And again, if they launched sells right there, what do they get right now? Buys. And this is exactly what they're going to be doing. They're just shifting their orders to buys and then usually see the market massively plummet into the highs. So in this case, they also use their own liquidity from here. And of course, they still generated some right there. So hopefully this little theory makes sense. Again, it's a little bit complex. And again, I don't want to get way too detailed about it, but I just want you to understand how it works, right? So this is the basic supply and demand zone theory. This is when you have usually an accumulation, manipulation below that, initiation outside, then you come back, retest the zone, and then the market usually goes in the overall direction. This is one type of supply and demand zone I'm using, and there is a second type. This is pretty much the rally base rally, drop base drop, right? So what happens is the market, this is usually happens after this. So after this develops, this is how we see usually supply and demand form as the market is in a nice uptrend or a downtrend. So we have this very nice push, the market pulls back and start generating like a little bit of a pennant, a little bit of a triangle, right? So people start selling right there. People are looking at this triple bottom. They start buying. What does the market do? They launch a fake move, right? So what happens is stop loss of buyers, new sellers enter the market as well. On the move up, they take out the stop loss of the sellers. They take out all the buyers. Then they return back to their fake move, right? And then they launch again. Exactly the same situation right there on the sell side. All right, so study those two examples. This is the theory. Here's a real example. Okay, so what do we have right there is something similar, right? So say at this precise moment right there, banks wanted to buy that 1 million lots, right? So what they do, again, the market looks like it's bearish, but there is probably something on the left, right? We don't know. We're just focusing on pure price right there. So what the market does is, again, it does this, right? Boom, 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 makes a little bit of a choppiness. Then it sharply moves to the downside, break structure down. If there are people that are buying right there, they're all stop loss, and there are people also selling right there with a stop loss above here. Then the market goes and creates a trend change. So what is this, guys? This is market structure. Trend change. And then again, so this is their fake orders right there. Then the market pushes up and then starts to consolidate, right? And usually the Asian range, which we're going to be covering a little bit later, is a really good example of building liquidity. So the market pulls back, consolidates for a little bit, tricks buyers to enter right there, tricks sellers to enter right there. And what they do is they launch again another fake move to the downside. Where? Exactly into the previous one. So they close their positions that are on the sell right there, turn them into buys, and look at the expansion. There is the expansion. And then again, so this is the first example that I showed you. So this is the first supply and demand zone, and there are the second one. So then you have a base, higher low, higher high, pulls back into the base, goes on and makes a new higher high. There is a new base, push, pull back, right? Pulls back into the base, makes a new higher high. Then here for a brief moment, the market needed lots of liquidity. So then they gave this big stop hunt to the downside. And again, this happens, right? So how do you know that this is a stop hunt? Because according to me here, we had a shift of market structure, but then the market immediately came in and shifted to the upside. So then I can say, okay, well, yeah, this was a liquidity grab. Right now we're bullish again, and I will be looking to flow with the market bullish as long as it goes. So that's the first example. Hopefully it's clear. There is another one, right? This one is also a very nice textbook one. So again, guys, pause on those charts, study them carefully. I'm going to be giving you away the PDF as well, so you can watch this at your own time. Again, bank right there decides to buy something. What they start doing is they start making a range. And usually, once again, as I told you, the Asian range is a really good confluence for that. They consolidate. Then what they do is they launch this fake move. So what is happening right here, a lot of people that are buying this support, they get stop loss. A lot of people on this breakout are entering also into sells. Okay, so there are a lot of orders being transacted just after we broke this level right there. The market pushes down, we get a little bit of an accumulation, then you can see, boom, the market expands. What happens is we have a trend change. So the market aligns bullish. Okay, then we pull back into the zone. And you can definitely be looking to take a trade right there. Absolutely. Right, then the market massively initiates outside once again. And then again, as I keep saying, the market is not perfect. So we still have this fake move. And again, we don't know. So a big question you might have right now is, okay, how do we know when you have a range like this, where exactly is it going to retest? Is it going to retest the top? Is it going to retest the middle? Is it going to retest the bottom? We don't know. We don't know. And this is why you should be taking the average. But what I show you in this example is that on this overall sell to buy, I'm going to be showing you more examples later. We take like just a simple flip and we drop the 50% and look at where the market came in later. How did it come in? I want you to pay attention. How did it come in? It tricked all the buyers. It tricks all the buyers from here as well. Massive move into the downside. What is this? It's a fake move, right? And then what happens immediately afterwards is they potentially close their positions right there, get all of their liquidity, massively pushes up. What does it create? A trend change. So what is the market doing right now? It aligned bullish. What caused this trend change? You immediately track it back. This is our major higher low. And within that higher low, you have that fake sell to buy, right? You draw it in, and this is where the market comes in, closes the orders, and continues to push up. Okay, so there is a great example of that supply and demand. Let me give you another one. All right, so there you can see the patterns right there, and you can see that it usually happens around the Asian range. We have a massive range right there. Again, what I told you in the previous lesson, what do we have above the range and below the range? Stop losses. There are people in shorts right there, there are people in longs, and on the breakout, you usually get also a lot of sellers entering. And this is what the banks want. They want the opposite order to what they actually want to do. Massive push. Again, you see how the accumulation happens right there. It looks like a lower high right there at the time. It tries to push down, launches even new more orders, and then boom. What do we have is we have a trend change. Very good. What happens right there? Stop losses of sellers are kicking in. So this is what they want. And then again, what caused this trend change right there? What is this? Well, it looks like a base demand higher low, right? You can see the market actually launched the fake, pushed up, came into 50%, then it pushed up. And then again, it comes into the demand zone, creates a new base, pushes up, pulls back. Here, we didn't really quite reach the base. Then a massive push up once again, it pulls back, creates a higher low, higher high. Then on the way down, it creates a trend change, but you still know that you have this base demand right there. And you can see the market came in, reacted, came in again, and it's reacting. Okay. So you can see the two types of supply and demand right there in a couple of examples. We first usually have the first example when the market is accumulating, grabbing the liquidity of everyone, creating a trend change, and then you usually find what caused the trend change, right? And you enter from there. And then as the market starts making an uptrend, then this is your main task, is to actually jump on that train. Okay. So far this is all theory. I haven't really jumped into how do you draw them and how do you do them, right? Let's have a look at some details. So as I keep saying, those banks or whatever they are, they will generate liquidity patterns around those supply and demand zones or when they plan to form a new supply and demand zone. And again, this is done in order to gather as much liquidity as possible. And usually the BFIs will trade in the opposite direction of the pattern they generate by creating this sell to buy or a buy to sell. Okay, so do we have a double top? What are the banks going to do is they're going to create a buy and then they're going to sell. Why? Well, because people are entering at the double top. They have their stop losses right there. And as this breaks up, there are a lot of long people that are trading the breakout. And this is exactly when they actually launch their fake move. They move to the downside. They come in, they mitigate their fake move and launch a new one. Do you see like a bullish flag? I don't even know how a bullish flag looks like. Is this a bullish flag? I don't know. Right, so what are you going to do? Well, people are going to be long. Maybe they give a little fake. Then they're going to launch the fake move, stop out all the people, stop loss all the buyers, get new sellers in the market, and then they're going to initiate. And what does this create once again is this range, the fake move, the market is going to come back and then continue in the overall direction. Okay, so you got to need that little mindset shift going forward. So what are the patterns? You have to ask yourself, what are the patterns that I'm seeing? And what does that mean for the majority of retail traders? What are they going to do? What position are they likely to enter? And then respectively, what will the banks do? Because the banks, they will usually do the opposite. Okay, so there is a little bit of a mindset shift you have to make. Remember guys, once again, getting back to market structure and timeframes. Higher timeframes will always prevail. So if you understand the foundation of market structure, then you are good. And if you combine market structure with supply and demand, this is a very simple but a very powerful system. And you don't need all of the other stuff, all the traps, the inducements, the blah, 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 blah. I promise you. So listen to me right now. We're going to go and touch on what a lot of you have been asking, order blocks, right? So what are order blocks? What's the difference between a supply and demand and an OB? How do you use them? How do you draw them? We're going to get into details. So let's get into them. So what's the difference? First of all, again, don't listen to me. I'm just a regular guy, having my knowledge, having my testing, having read through all the content that is available and actually having done the testing myself. So I have experience and I have results to prove what I do. According to me, they're almost the same, right? But they have slight differences. So many people, so many traders, as I mentioned in the intro, trading is unique and you have to find your own niche. Because many people will draw supply and demand zones, they will draw order blocks in different ways. right? And then there is no wrong and there is no right way to do it. If somebody comes on and tells you this is the right way to draw an order block, sure, that's the right way for you. I draw it in a different way, right? So again, you have to find out what works best for you. Usually, an OB, according to me, is the last sell candle before the big buy or the last buy candle before a big sell. So in this case, the time frame you look at it will matter because you can have a series of sell candles on the 15-minute, but on the 4-hourly chart, it can just be one candle. So be aware, and I'm going to show you examples on how exactly to draw them. What we usually try to find is the last candle before an engulfing occurs. So this actually makes us refine a zone which shows us exactly where that fake move happened, where did that sell to buy and buy to sell occurred. And it looks pretty much like this. You have a bearish candle and then you have a very nice engulfing candle. And this engulfing candle needs to engulf the full candle, the wick and the body. And then how do you usually draw them? You take the candle like this, right? You have a buy and then the very big sell that engulfs the previous candle. And again, there are a lot of rules to it. So let's get into the rules. So what are the details and the rules? We always need to see an SB after the creation of an OB. So this pretty much forms, once again, our major lower high or higher low supply and demand zone. Okay, so as I told you previously, why do those major higher lows work? Well, because they have a lot of demand inside them, right? So if you remember, when we have an uptrend, the market creates a trend change and then confirms the trend change. Okay, this is our major high and this is our major low, right? So then usually, again, right here, you're gonna have supply, and I call them lower high supply, right? Or you can call them OB. You can call them whatever you want. This is a strong high that caused the break of structure, and again, this is potentially where they also launched a little bit of fake moves, so the market should not usually go above this high. Why? Well, because if the banks really launch the orders right there, they wouldn't like to get a stop loss or they wouldn't like to get further into like a loss. So usually then you're gonna see those highs respect perfectly, because pretty much that's where they close their positions on drawdown and they enter new ones. So always, you need a structure break or a trend change, period. Always look for momentum as well when an OB is printed. So if you have like a choppy and a slow break, that is weak. So don't take it. Once again, the candle must be fully engulfed by the next one. Okay. A lot of details, so the higher the time frame, the bigger the zone, and the more important it is. So I want you to actually avoid refining too much. So don't do like a 4-hourly zone, a 1-hourly zone, a 50-minute zone, a 1-minute zone. Don't like pick one big zone and then refine it on all time frames. Pick one time frame and use that time frame only. Also, an OB is considered to be fully mitigated or retested once it's at the 50% mark. So as I told you in the previous example, we do not know where the price is going to stop and reverse. Is it going to be in the upper 25%? Is it going to be in the middle? Or is it going to be a little bit below? Right? So if you have a zone like this, you have 25, you have 50, and you have 75. And then what a lot of people do is, again, you either enter for the 50% or you enter from the 75 or from the 25 or from the open. Right? We don't know. The price can come in and kiss it and run away. The market can come into the 25 and run away. It can come into the 50 and run away. It can come all the way to create an equal and then run away. We don't know. And as I keep telling you, as everything in the market, OBs are also not perfect. Oftentimes, the price will even not tap them or just kiss them and go. You have a zone, the market just comes in, ping, and just forgets about you. You don't even get your finger on the sell button, right? Sometimes what could also happen, what I've seen happen, is the market can throw a little wick and then still reverse. And that's fine, right? But this is why we always wait for a lower time frame confirmation within such a supply and demand zone, right? So those are your rules. So print those out, take note, because if you lack one of these rules, your supply and demand zone is not going to be perfect. And once again, in order to keep it really simple, major structure is always going to have supply and demand zone within. So more details. The zones, as I told you, form in many different ways and they might confuse you. So I want you to make your drawings systematic and draw those zones in the same way always. So I've picked here a couple of examples. All right, so you can draw this in numerous ways. There is one way to draw it, right? So usually what you take is the engulfed candle, and in this case the engulfed candle is the bearish one. But I also like to take the highest point, because if I just take it from here as well, then I miss out on actually what is the major high right there. What you could also do, if I just delete my drawing, what you could also do is you can just take the bullish candle. So you take the whole bullish candle, and although the next candle did not engulf, right, there is an engulfing here, right? And if we go to a higher time frame, it is going to be engulfed. Okay, so you can draw it like this. So in this case, those are the two ways that I'm going to draw it. Okay, this one, pause the video and draw it. How would you draw it, right? This one is rather simple. There it is. So this one, it's very little. So this one is very little. So use a higher time frame to find an engulfed candle and make it bigger. What I usually do is I go to like a hard time frame, like if this is the 50-minute time frame and the candle is so small, I'm gonna drop to like a 20-minute or a 25-minute to find a bigger candle that is engulfed. Because as I previously mentioned, you don't want to refine too much, and I'm gonna show you why later. Third example. Here we have a candle that is engulfing two candles. So you pretty much have two ways. There is the first one, you take that small candle once again, or you can also take the big one. And I promise you, if you go to let's say this is the 15-minute time frame, if you go on the 25-minute time frame in this case, there is going to be a perfect one candle up, massive candle down that is perfectly engulfed. Okay, so you also have to work between the time frames, because if you, let's say if you have a demand zone like this and you only keep the first one, the market can come in and reverse. And you're like, oh, well, it didn't tap my zone. Well, it didn't tap your zone because you're way too refined. So again, have a look where the engulfing is and see, always strive to make your zone bigger. That's according to me, because else you miss on a lot of trades. Last example, how would you draw it? So again, numerous ways to do so. This is how I would do it. So I would always account for the highest wick or the lowest wick. Okay, so I'm not gonna draw it like this, just with the bullish candle, because then again, you miss out on the major high, which is right there. Okay, a lot of you can also just draw the wick. That is perfectly fine by me, right? But again, it's a little bit refined. So we can only draw this wick. Personally, I like to take the whole sell to buy, and I'm going to be dropping to a higher time frame right there to find the best candle. And I'm going to show you examples in a bit. Okay, so study this once again, have a look at all the different ways to draw them. And again, guys, very important, make your drawing of the zones systematic. So you draw them exactly the same way every single time. Here is an example of why timeframes matter and why higher time frame is always better. So once again, do not refine too much. So it's much better to keep a bigger zone and work your way on the lower time frame than to refine too much and then just not get a tap of your zone, right? So essentially, those supply and demand zones are areas of value from which you are going to be looking for entries on the lower time frame. Again, a little detail, so if you enter aggressively, then you would maybe want to refine. So if you're going to be entering without a confirmation, which we're going to be covering in the next video, then of course you can refine. In this case, what we have is a 50-minute time frame right there. And again, look at this candle. This candle engulfed all of this. So in this case, you can take this little candle, you can take it from here as well, or you can take the whole zone like this. Okay, but what I would do is I drop to the hourly time frame, and on the hourly time frame, we have a textbook bullish candle. We have a textbook order block right there. It made a buy, took liquidity on the left, massively rushed lower, and caused the break of structure. And in this case, I would take the hourly zone because it offers me a lot of wiggle room. And when the market comes in, that's when I'm going to be dropping to the lower time frames and looking for my entry patterns. But again, if you just want to enter like in a swing trade or you want to be refined, then take your 15-minute zone, set your limit right there, and stop loss above. Again, different strategies. We're going to touch on those a little bit later in the next video pretty much. Let's have a look at some examples, right? I always want to give you examples. We're also later going to jump on the charts, so for me to actually show you how I do it. So this one is complex, so you might have to pause the video and study, right? So we start from here, and again, market structure is key. So here we have like a bearish candle, then the market pushes up and causes a 15-minute break. So we have engulfing candle, we have momentum, and we have a break of structure, right? And you can see the next candle immediately comes in and retests this area. Okay, so you can see like in this case, as I've said right there, this bearish candle is not engulfed by the next one. Again, you can make an exception. You can also take this candle, which is the engulfed one, or you can go to find another time frame where you actually find that bearish candle being engulfed. The market pushes, it creates a higher low. This, according to me, here is a structure break. According to my rules, there we have a trend change to the downside. What caused this trend change? The last bullish candle. There is the break. Once again, this is the supply, but I would also always account for this guy. which is our major high. Okay, but this is where the OB, this is where the supply happened. The last buy, sell, massive sell. The market comes back, retests it, massively launches lower. Okay, here before the break, what happens before the break? The market creates this buy candle and massively launches lower. Okay, so then we're essentially going to be looking for the pullback, but what the market did, continued to push lower, created a lower high, and launched another massive move lower, right? So again, in this case, this one is still valid, but in my strategy, my very systematic system focuses only on the most recent ones. So I'm giving you a very big hint right there. I do not focus on old supply and demand zones, right? So here in this case, this is the last bullish candle before the break. The market massively comes in, right, and just breaks it. So maybe we got an entry right there. I'm looking at the wicks. Maybe you got a 1 minute entry. I'm not sure. Well, maybe you take a loss because again, you can see right there, the market got oversold, demand kicked in, and the market is starting to reverse. And there is probably a demand zone on the left, which is why higher time frame always matters. This is maybe a 4-hourly higher low because this is the 50-minute we're looking at. So maybe this is a higher low. The market aligns bullish, right? And then have a look here. Remember the old one, the market comes into the old one and actually makes a trend change down, okay? But yeah, so it gives us like a little short-term bearishness, but again, as I keep saying, keep in mind the hard time frame. This is the bearish candle. It's not fully engulfed, so we have to look at a different time frame, but again, look at the engulfing candle right there that caused a break of structure, in fact, the trend change with a lot of momentum. So this one is still relevant because it signifies that a higher low is forming. And this is a very powerful demand zone because it's the one that actually caused the trend change at a 4-hourly higher low formation. So very, very, very powerful zone. I've backtested this. We actually have it as an entry model in my community. So what happens later is that again, in terms of the 15 minutes, so again, there are a lot of details on this example. In terms of the 15 minute, this is the major high and this is the major low. So we are bearish. But again, according to my entry rules, I will be looking for longs from here. Based on this, I call it a TC demand zone. The market then pulls back into the supply that actually caused the trend change to the downside, reacts. What is it building right there, guys? Let's focus. What does it build? A very big consolidation. What happens? Fake move below the consolidation into the last sell to buy. That was internal. So this is internal. Why? Because this is our major high and this is our major low. Anything inside is internal. But you can of course also read the internal. So here we had this sell-off and then the market massively expanded. So then again, what caused this expansion? This is the last sell candle before the break. And yeah, I see it massively pushing up. So probably it's not going to return. So we got to right now keep following with the base supply and demand that just pushes and continues. Okay, so very comprehensive example. Study this one. There is a lot going on. So let's explore all of these. So right now I'm gonna be, so keep all of these in mind, right? So I'm gonna be dropping right now on the 1 minute and actually showing you how you can execute from those supply and demand zones on the 1 minute by using the same OB and the same supply and demand rules. So let's jump into it. There is the one that, so this is the OB that caused the TC and a potential 4-hourly high. So this should be this one, right? So this is where we are at a 4-hourly high, right? We make the first 15-minute alignment down, which means that the pullback is starting. So this is where we're going to be looking to enter a trade. So dropping on the 1 minute, what do we have? There is this massive range, a massive buy, a massive sell-off. The market slowly pulls back. Tap into the zone. Give us a 1 minute alignment, right? So then again, what caused the alignment? You can see there is a little bearish candle right there. What I would do in this case is, once again, I'm really not going to look to refine too much. I'm just going to take this whole buy to sell and enter somewhere right there. But I've done this very precisely towards this bullish candle right there. And you can see the market came in very aggressively. How did it came in? With a massive fake move. A massive buy, stopped right there exactly, and started reversing. So what is this buy to sell right there? This is the fake move they're launching. So what are they going to do? They're going to come back, take some off, and then continue. And again, what I usually do is I take the buy to sell. And again, as I told you, we don't know if they're going to tap the open, the 25, the 50, or the 75. In this case, they perfectly reacted from the 25% of this buy to sell, right? So this might be a little bit advanced for some of you if you're looking this for the first time, but I know a lot of your experience with that stuff. So hopefully it makes sense. So that is the first example. Let's have a look at the second zone we have. So this is the one that, so this is, let me show you. So this is this zone right there. The market made a new lower low, right? So we had this massive drop. So there is the short trade we took. This is a massive trade if you actually, of course, hold it. Right now, we're looking to enter from here because this is the last high. This is the last low, right? And we're looking for a short. However, the market comes in. Again, what it does here is massive sell-off, pushes, consolidates, pushes up. So do you see any entries here? Not really. If you don't enter aggressively, higher high, higher low, higher high, higher low. Yeah, it pretty much broke on this wick right there. So this zone was immediately invalidated. And as I told you, we had like 2 wicks right there. There are no entries. So we do not take a loss from this zone, which is perfect. Okay. Next example. So this is the one, this is the old one, right? Which is a reaction point. But again, even if you trade from it, the market, what does the market do? It makes a range. It creates a massive buy, creates a sell, then comes back to retest that buy, gives us the entry. Okay. If you zoom in, what caused this sell, right? Well, you see here, I've taken this little bearish candle. Again, in this time frame, you can use a different time frame to find the proper candle. You can draw it like this. You can draw it like this. You can draw it in many ways. What's important is that you understand the psychology behind it. The market came in, rejected for a little bit, pushed down, pulls back, pushes down. Where does it go? Into that TC demand zone on the left. That is a strong one. Taps inside, lower low, lower high, lower low, lower high, lower low, aligns bullish. There is the last sell. There is the last buy that aligned bullish. Again, where is the market going to come in? So if you do the mistake of doing this, in this case, you miss out on the trade. So again, as I always say, keep a zone bigger. And if you get a good stop loss, just enter the trade. Because in this case, we didn't even go to the 25%, right? So then we have a push up. But then again, if you remember, guys, in this case, this was our major 50-minute high. This was our major 50-minute low. So we took the long, but we also have to take the short. Why? Well, because we are also bearish. The market taps into the zone, higher high, higher low, higher high, then it aligns bearish right there. You take the trade and we are running into profit. So you can see there are trades everywhere when you pick the right supply and demand zones. And there is that internal bullish one. I just want to show you a couple of examples. We have an OB right there. We have a range. The market pushes into it. Lower low, lower high, lower low. How does the lower low form? With a massive sell followed by a massive buy. Okay, so you know, oh, I've seen this pattern. I know this pattern. Ilya taught me this pattern, right? The market comes back. Where does it hold? 50%, right? Even here it went to the 75% as well. Okay, but spot that I didn't do this. What I did is the whole leg, the whole sell to buy. So again, I do not refine because I've refined way too much to enter like with a 1 pip stop loss. It just doesn't work. I'm telling you for now. In this case, it worked great. So you could have entered a trade from here with a 1 pip stop loss and you nail a massive banger. And that's fine if you want to do this. But the majority of the times, you're going to be missing trades. Okay, so there are a couple of examples, right? And we're going to jump on the chart so I can actually show you how it works. Another concept I actually want you to understand is the fractal nature of the market. So what I just showed you is the fractal nature of the market. We drew 50-minute zones in the same way we drew the zones on the 1 minute as well. Okay, so the same things will repeat on every time frame. Price doesn't know time and time doesn't know price. So very important, kind of a mind-shifting sentence right there. I still kind of find it hard to really accept this one, but it's true. Right? So price, which is the way price moves, it doesn't know the time. It doesn't know the time frame. And the time frame doesn't know the price, right? Because price is price. It's all the same. Different time frames are just a different representation of price, right? And again, as I said, there are patterns within patterns. So we can have that same thing on the hourly, the fake move, the push, the retest. Within this hourly demand, you can have the same thing happening on the 15-minute. Right there, the 50-minute gives you a range, manipulation, pushes outside, comes back to retest. Within right here on the 15-minute retest, you can have the same thing on the 1 minute. And this is pretty much top-down analysis. This is why all you need is 3 time frames to be profitable. A hard time frame, a middle time frame, and an entry time frame. And all you do is apply the same pattern. Of course, with some more kind of additional stuff. So hopefully it makes sense. There are a couple of additional things that I teach in my program. One of them I call the RIM. This is kind of a real sauce. It's a very deep understanding that one can have on supply and demand, but I'm gonna keep it away from now. It's pretty much like how actually does the order block form, what are the different phases within the order block, and how you can actually trade it, right? But again, we're not going to be covering this in today's video. Another one that is also worth to have a look at is order flow. So right, order flow, how the market goes up, how the market goes down, and how you can actually follow the order flow and really know who is in control. But once again, order flow is spotted within market structure, combining it with supply and demand. So right now I want to just jump on the charts and actually find as many examples as possible, because I want you to see me, how I draw those zones, how I look into them, what are like the different little details that I said, like if it's not clean on one time frame, how do you drop it on another time frame and draw it, right? And we're going to be focusing on multiple time frames and also combining right now supply and demand with market structure. So we're going to be spending some time right now on the charts, and in the next lesson, I decided in the next lesson we are going to touch on liquidity, because for me to lay out all the liquidity concepts, I know it's going to take me another 40 minutes, and I don't want this video to be, again, 2 hours. So we're going to do it in a separate video, which is going to be easier for your learning journey. In the meantime, if you have any questions about the theory, about what I mentioned so far, let me know in the comments, okay? What is unclear? Is something that I explained not making any sense? Am I speaking BS, right? Do you find hard to understand something? Let me know, because again, apart from those lessons, later we can be doing additional lessons with more examples and all that stuff. Because my mission is to help you prepare with all the foundations, to give you that knowledge so you can start making progress, and then you can come to me as a mentor so I can actually coach you towards consistency, towards the right mindset, the right system, right? Because what I give you right now is a lot of things. It's theory, right? But it's a separate thing to actually put it into a system that is replicable, right? And you can do this every single day, every single day, every single day, and see consistency in your trading. So let's jump on the charts. All right, so here we are on an empty EU chart on the 4-hourly time frame. I'm completely freestyling this. I don't have anything prepared. We're just gonna go on, find some supply and demand zones, and on different time frames, walk you through it, how I draw them, how I've set up my chart. So let's go. First of all, on my rectangle, I have around 4 to 6 different things. I have higher time frame demand, higher time frame supply. That is 4-hourly and 15 minutes. Okay, so if you actually have a look at my settings, those appear on every single time frame because I want to see them. Okay, and then I have a lower time frame demand, which is only on the 1 minute, right? And I think 5 or less. What I also have is the manipulation, right? So this is what I told you about, like that fake move, which we can try to spot right now. And what I also have is a range, because again, usually the manipulation happens below or above a range, or of course it could be a single high or a single low, which we're going to be speaking in the next video. Okay, so I actually want to start with a trade that I just took this morning, just right now, because it's very fresh in my mind. So what are we having right now? Here, the market broke structure to the upside. You immediately track it back. What caused the break of the structure? It is this one right there. So I'm going to tell you it's this one. Is this a clear zone? No. So the last sale candle is this guy. So in this case, I can either take it like this, or what I'm going to do in that case is I'm going to do 5-hourly time frame. The candle is clean, still not engulfed. 6-hourly, not great. 7, nope. 8, nope. So you can see in this case, so there it is on the 9-hourly time frame. We have the spin bar that is engulfed by the next one, immediately came back to retest, and then it pushed. So again, if you want to be precise, and if you just don't want to be dropping zones, then you can do this. Always go upwards of the time frame you are at. Don't go downwards. So I'm not going to go to the 3-hourly, to the 2-hourly, and the 1-hourly to refine, because then you get too refined, because then what you're going to do is you're going to do this, right? And yeah, you can see this one worked in terms of intraday, but I'm just looking at this major zone right now. Usually I'm going to draw it like this. Okay. Here, for example, the market broke structure to the upside. Okay, we track it back. What is our major, our low? It's this guy. Okay, so what is our demand zone? Well, you want to take the last sell candle usually, or you want to take the candle that is engulfed. Another great example of how the market is not perfect. Like in this case, I only took this one. Is this engulfed? Yes, it has a little bit of imbalance right there. If you're looking at imbalance, it caused the break of structure. What you can also do, 5 hours. Do we have something? It's pretty much the same. It's a slightly bigger candle. 6 hours. Let's check it out. 6 hours, it's even bigger. So I'm going to take this, right? 7 hours. Do we have actually a bearish candle that is engulfed? Not really. Okay, so maybe 9-hourly. No. So in this case, we just don't have it. So your task is to make this as bigger as possible so that you have wiggle room and the market comes in here to actually take a trade. Okay, so then we can jump into look at what happened on the 50-minute right there, what happened on the 50-minute right there. Right now, let me actually show you my trade for today. So where is the market right now? It's making a massive lower low. What is it? It's oversold. Okay, what did it also do? It created a new hourly break structure right there. It made a lower low and it came in and took out this low. Okay, so what I'm gonna teach you in the next lesson is that again, old lows and highs like this, they have a lot of liquidity. So when a low like this is taken, usually a pullback initiates. And this is why higher lows and higher highs form. When you have a high, higher low, higher high, above this high, there is liquidity. So when it's taken, usually the opposite side of orders are triggered. So then the market pulls back, right? Higher high, then the market pulls back again. So when I saw this high being taken, and pretty much I didn't even see this high at first. Oh, the market is at a lower low. Cool. What are my options? To either continue flowing with the market down or look for a counter trend. Then I drop to the 50-minute time frame. Let's read the 50-minute. What we have right there is our Asian range. So if you haven't watched my Asian range video, it's a good time to do so, but I think it's actually going to be even a better time after the liquidity lesson, right? So what did we have right there is, again, I'm just tracking structure. We have breakout structure right there. We have breakout structure right there. And then what happens all of a sudden is the market creates a trend change. How did that happen? Let me ask you, right? With this. So what I do this right there, it's manipulation. That is our sell to buy that caused later a trend change. So if you were early in this market, 7:15, you can be looking to take a trade from here. Because this is the last sell candle that was engulfed, caused the trend change, pulled back and gave you a long trade. What the market does later is it makes a breakout structure. What caused the breakout structure? So again, as I keep saying, the market is not perfect. All right, it's not perfect. This is the bearish candle. Right, but you can also take this one. So what I will do in this case is go to the 16-minute, not really, 17-minute, not really. And I'm here just to tell you that there is no clean candle to take, exactly in this example. But I know that we have a breakout structure. What is my major high low? It's this guy. So there is demand within this major high low. Okay, so what I did is I dropped to the 1 minute. So there is that, where is the first trade? Yeah, there is the first trade. So again, how do you take the first trade? The market pushes up, it creates this sell-off, and then it buys, right? And what you can see precisely before the big buy, what do we have? Is this sell. Where does the market go? Precisely 50% of the last sell to buy, okay? I do this with the Gann tool, all right? So this is the Gann box, and I have it like this. 0, 50, 75, and 1, and almost no background. Right, so there we go, 50%, boom. This is actually an entry model we have. It's called the 1 minute continuation, Fanatic entry model number 3. The market continues to push up, right, and causes a 50-minute breakout structure. What do I know is that there is demand within it right there. So also liquidity has been taken. I'm not going to speak about liquidity in this lesson. We had a trend change precisely right there. So then look at this, right? Same thing on the 1 minute that we do, same thing on the 50-minute. There is our breakout structure. That was actually a trend change. What caused this breakout structure? It's this guy, okay? What do we have actually right there is we have a massive sell to buy as manipulation. What did that do? Range, and massively went down, took everything. Where did it go? Into the previous sell to buy. And what did it tap? 50% on the spot, right? So there were quite a few trades this morning, but I don't trade at 6. I don't trade at 7. I trade after 8. So I could have taken this, but I was looking for a confirmation because I don't trade aggressively. Push, pull back. I took the trade here. Stop loss below the major low. And there is my 4-hour trade. So lovely trade this morning, right? Right now, actually, there is a short I just missed. I just missed the short. I'm actually looking for it on my other screen. I'm looking at it on my other screen and I was going to take it. But again, I'm doing this for you. But let's break it down. Let's break it down. What do we have? A little bit of a choppy market right there, but let's just follow price. There is a breakout structure right there. What caused this breakout structure? According to me, it's this low right there. It actually could be this low, but I'm going to take this one. What happens is we have a trend change down. What is our major high? It's this one. Where is the supply? It's this one. Is this a valid supply? Yes. It's a nice bullish candle that is engulfed by the next one, and it caused the breakout structure, right? What I do is I drop on the 1 minute. The market comes in, grabs the liquidity. What does it do? Takes out the high. Takes out the high. What caused this high? It's this one. So there's our trend change. Man, I should have taken this trade because it actually broke on this candle and you can already be in from here with a massively tight stop loss. But I was actually looking to take it from here. I was just monitoring this chart. I should have maybe paused the video. But let's see. I mean, we have a live trade running. So let's see if we can get our full hour in this trade. Again, why from here? Well, pretty much again, what caused this break? It's pretty much this whole, again, buy to sell. Right there. So this is where I would eventually be looking to take a trade if I get a good stop loss, and I will be looking to like go break even after, yeah, break even and trade management, separate lesson. So there is another trade. I did not pause this video and take this trade because of the time. It's I'm currently not trading at 12 o'clock. I stopped trading, and usually like 20 to 15 minutes before that I also look not to trade because then the market is getting into chop state and I'm happy with my win, so I just decided not to take this one, but let's see if it works out. Okay, so again, textbook setup. So let's go back to the 4-hourly time frame, practice a little bit more. I wanted to break down this right there. So we have a massive push up, we have a very nice pullback. So let's actually do this, right, and go and explore what is happening within this demand on the 15-minute. Okay, so what is all of this? So I'm giving you a quiz right now. What is all of this? Right, what is all of this right there? I hope you know. This is internal structure of the 4-hourly range. 4-hourly high low, 4-hourly high. Dropping on the 15-minute. Let me break down this internal structure. It could be a good lesson. On the 15-minute, this is where we created the trend change. What caused the trend change? It is this little guy right there, which again is not clean, but this is the last buy that caused the sell and caused the trend change. In this case, what we can do is we can do 25-minute. There it is. 25-minute buy candle, massive sell, causing the trend change. However, I base this on my base time frame, which is the 15-minute. All I do is 4-hourly 15-1. The only time I switch time frames is when I want to take a nice zone, but I pretty much know how the zone is going to look like on the 25 when I'm on the 15. So I pretty much knew that if I go on the 25, this is going to be a clean OB right there. What does the market do? Comes back, chops for a little bit, and then at the end of the day, it explodes down. Exactly right there, it caused the break of structure. Do we care what happens right there? No, this is all internal. This is our, again, remember the exercise. This is our major high. This is our major low. Anything between these two levels is internal. Of course, this is where we're going to be looking for an entry. So do you want to drop to the 1 minute? Have a look if we got an entry. Let's do so. All right. So we come in. Ooh, this is very, very, very choppy. So let's see. Here, high, low, boom, trend change. What caused the trend change? Very clean OB in this case. There it is. So what do? Is we take our trade. How do you take it? Are you going to take it from here with a 1 pip stop loss? Are you going to take it from here for a 6 pip stop loss? I don't know. As I told you, if you have this big buy, you draw your gun box and we don't know where the market is going to stop, which is why I always say if you get a good stop loss, just get into the trade. Personally, I'm going to do it from the 25% because it gives me a 5 pip stop loss. And we got our almost 3R. Almost 3R. Okay, so this is very debatable. If we take TP, if not, then I think we're probably break even because I wouldn't really hold the trade as it gets to 3R and then get a stop loss. So this is either, I mean, if you took it from here, you're definitely having a take profit on this trade, right? Oh, sorry. If you took it like this, you're even having almost a 5R. Again, we're here not to take trades. We're here to learn. The market returns back, right? And actually technically takes out this high on the 1 minute. What caused this high to be taken? Is this high or low? What happens is the high or low gets smashed. The next question you ask is, okay, what actually caused this high or low to get smashed? You track it back, it's this. Do we have a clean OB in this example? Not really. Okay, so how you can draw this one is you can take this candle because this is the candle that was engulfed, or what you can do in this case is go 2 minute. Right, go 2 minute. And there is a slightly better candle which is still bearish, then you can go 2 minute. No, 3 minute gets a little bit bigger. Okay, so again, experiment with it. Find the time frame that works best for you. Personally, I'm gonna take it like this. The market comes in, it came in right there, take the trade, safe stop loss of 3 pips, and a massive rundown, right? So you see, we literally caught the top of the trend right there. Volatile high, 50-minute trend change, boom. And again, not to say how many trades you can be taking along the way, but this again is our entry models, which we're not going to talk about. So dropping on the FOIC, once again, what do we have is we have a volatile demand zone. The market is coming into the volatile demand zone. Let's see what happens. Okay. By the way, I want you to right now go in and practice all supply and demand zones right there on the 15-minute because they are tricky. This is where we broke right there. Okay. So how do you drop a demand zone right there? A supply, sorry. Well, I'm going to take it personally like this. Why? Because if I go right now on the 25-minute, this is probably going to be one candle. Okay. You can do it like this. To me, this is too defined, right? You can even do it like this. This is how the majority of my community does because I've taught them to take bigger zones and then master their entries on the 1 minute right there. So if I just quickly drop to the 25, not really, right? So 24, 23, right? So there is a good one, right? So we have this bullish candle and I'm always going to take the wick. So that's a proper zone. The market pushes down, it pulls back to 50%, but it doesn't tap our zone. Well, that's fine, no trade. What does it go on and do later? It causes a break of structure. What caused the break of structure? We'll have a look here. You have a little detail. So you have the bullish candle, bearish, then this candle throws a huge wick above and closes. So again, what you can do in this case is you can take the wick like that. You can take the wick like this, or you can take the whole candle, or go to 25 and there is your candle. I mean, the 25 candle is, it's technically engulfed by this one. Maybe you do 24 minutes. Yeah, there it is. So 24-minute candle, bullish, full engulfed, caused the break of structure. What you do, the market comes in right there, you drop to the 1 minute. Oh yeah, in this case, you did not get an entry because as the market aligned, I remember this trade, it just made the TC right there and it just forgot about us. So no trade. Do we care? No. We keep following the ranges. Okay. So this is actually practicing supply and demand, but I'm already marking up market structure as well. There is a break of structure. What caused this break of structure? Track it back. It's this guy. What is the supply zone right there? It's very clean. Bullish candle right there, but always also embrace the high. Okay, so don't take it like this so that you leave out the wick right there. Always embrace the high. The market pulls back, doesn't get in. Where did it get in? Inside this whole buy to sell. So this is why don't refine too much, right? But don't also make it way too big. So I try to find the happy medium, which in this case, if you drop to the 25, it's going to be the 25. And it did not tap. Massive push lower. There is a break of structure. The market keeps moving down. What is the major high? It's this one, right? What is the demand zone? Again, tricky right there. We don't have it perfectly. Okay. So same example. The market creates a bullish candle, then wicks above it, and then massively drops lower. Okay. So what you can do is you can do this. Or you can catch even the bullish candle, which is what I would do personally. Catch from the buy to sell. Or 25 minutes. Not really. There you go. 25 golden. Sorry, 24. Golden. Massive drop lower. That's the supply zone, but the market did not come in. Okay. So right now we are in a 4-hourly demand zone. So what you have to be looking for is for the 15-minute to become bullish. Let's see if it actually does. There it is. Minute became bullish right there. That was a tricky price action right here because it caused the high, then it caused the trend change right there. So it's getting a little bit tricky. So I think we play a little bit more. Yeah, so there it is, right? So we have this massive expansion higher. Then the question you actually have to ask is what caused this expansion higher? And I think I took a long from here because this is what caused the expansion. Okay, so we have a structure break right there. This is also, I have additional rules that I'm not sharing with you. Those are for my private program because we also have the valid ranges rules, and usually a valid range is also going to determine a valid supply and demand zone. In this case, it was this guy. So what I did is I dropped to the 1 minute. Did I take a trade here or did I miss it? Because it tapped, it pushed up. Yeah, then I was looking for a 1 minute entry right there and it did not. Okay, so maybe I took, yes. So this is, I took this trade, by the way. This trade like this. Why? Because again, we were bullish on the 15-minute. The market came in. This is where we aligned bullish. So how, again, in this case, how do I drop my zone, right? You can do this if you wish. In this case, it worked out great because this is the actual sell candle that was engulfed and massively pushed up. So if you want to, 2-pip stop loss, beautiful. What I do is, again, I spot where is the sell. There it is, right? Then take the GAN box if you wish. In this case, again, perfectly 50%. But how I entered is, I think I entered a little bit higher. I mean, something like this. And I think that was a stop loss. Oh no, that's a take profit. Okay, I'm probably confusing the trade, but this is Friday. Yeah, so I took this trade. Yeah, so it looks like it's a TP. I don't even remember. But there it is. Simple trade. Bullish 50-minute, 1 minute aligned. We find where it aligned. Boom. 3R. But I think, yeah, later... Yeah, it actually went quite nice, this one. So why don't I remember this trade? I don't know. Doesn't matter, right? We just found it, which is pretty good. What the market does later is, if I just actually remove some drawings, the market breaks structure to the upside. What caused the break? It's this. This is our major high low. Again, in this case, demand zone is not perfect. You can take this bearish candle, but you can see this bearish candle is not engulfed, right? There is a wick right there. So what you do is you go 25. Is there something? Not really. Yeah, on the 24, so you can see on the 24, we have this very nice bearish candle engulfed by a bullish one. I'm going to take this one, right? Then you wait for the market to return, drop to the 1 minute. Let's see if we can take a trade right there. Yes, so there it is. There it is. So again, you can see how the market works, right? So again, supply and demand concepts. Consolidates a little bit, generates the liquidity. What does it do right there? Right, that fake move that I told you. And there's the fake move. Followed. Usually what I would like to see in this case is a momentous push up. This one is very, very, very choppy. What caused this trend change? It's this guy. Is this perfect zone? No. Right? So why I took it like this? Because again, I am not going to take something like this or something like this. I'm going to take it bigger like that and just look to enter with a safe stop loss. The safe stop loss in this case will be actually below this low, which gives it a little bit bigger. So again, choices. You have to make choices. Then in this case, are you not happy with a stop loss? Then wait for a little bit lower. Okay, but this is a trade that I will be personally taking. And yeah, so this was the stop loss. So maybe I took the win. Oh no, that is Friday. Yeah, maybe I took the win and then took the stop loss. Probably that is the case because I remember there was a stop loss right there. Yeah. So I took the win and then I took the stop loss. Exactly. So again, valid trade, but the market did not move. So what happens right now is as soon as this one is violated, we have a trend change down, right? Where is our supply zone? Well, in this case, it's actually this guy because this is the last buy, which is a valid range that actually caused the break of structure to the downside. Okay, so what you have to do is wait for the market to come in, but then it immediately broke it, all right? And then you just flow with the markets. This is why I hate doing the flow with the markets Tuesday, because I say I'm gonna sell from this level. The market just massively breaks above it, right? And then again, what TC right there, what is the low that caused the TC? It's this one. What is the demand zone? It's clean. It's this candle. If you want to make it bigger, go to a hard time frame, right? So nothing very clean. So I'm going to keep the 50-minute. You wait for the market to tap. You go on the 1 minute. You take your entry and you hit TP. Where is your TP? At the high. Okay. Same thing. Break structure. What caused the break of structure? Right now, we move right there. We move right there. Again, demand zone, not entirely perfect, but we have a bearish candle right there that was engulfed. But remember the rule, always account for the low. So you account for the low, push, pull back. Do we tap in? Oh, okay. Yeah, so this one was just massively broken. We absolutely don't get the 1 minute entry right there. Okay, so I think this is pretty sufficient. Okay, so again, the main rule is when you are on the 4-hourly time frame and you don't have a clean zone, go to the 5-hourly, 6-hourly, 7-hourly, wherever, right? When you're on the 15-minute and you don't have a clean zone, then go to the 25, 24, whatever, right? So just try to pick a proper zone, okay? So if we just go and see how our trade is looking like, it's chopping. This is why I don't trade at that time because it's chopping around. But yeah, pretty much there is our kind of, no, this is wrong. There's our manipulation, right? The market comes in. Well, we took it from here. Right, but it came in again, gave again a massive reaction. So we're, yeah, just sitting in that trade, but let's see how it works. So right now, I just want to wrap it up and have some final words. All right, fanatics, I really hope you enjoyed the lesson on supply and demand and order blocks. Hopefully it has made sense and you are ready to actually go on your charts and practice. I really urge you to rewatch this video at least 2 more times because there was a lot of theory and then I spent a lot of time, I hope enough time, to walk you through some charts, to actually show you some examples and even give you a hint of the entry system that I'm going to be teaching you after 2 videos. In the next video, we're gonna touch on how to understand liquidity. I'm gonna break down all the different types of liquidity, how to then add up on your supply and demand and market structure knowledge. You add liquidity on top, then we put it all together, we add the entries, and you're absolutely ready to crush the market. So all I ask for you is to subscribe to the channel if you like this video, make sure to turn on the notification bell in order not to miss when the next video comes out, and just hit a like, right? And let me know in the comments if you enjoyed it, because I really hope I'm providing some good content, and it really means a lot to me when I hear it from you. So wishing you an incredible week ahead. Study. If you have any questions, always leave a comment or message me via email at support@tradingfanatic.com. I'm always here for you. I'm always here to help. If you need anything or you need another idea for videos, anything at all, just let me know. So right now, it's study time. Good luck, and let me know if you have any questions.